What if I told you the old rules for keeping your money safe are broken? For decades, the playbook was simple. Buy stocks, buy bonds, maybe stick them in a 60-40 split, and you're good to go. But what if that playbook is dangerously out of date? What if the very foundation of portfolio building is cracking under the pressure of a totally new economic reality? 2026 is shaping up to be a year where the traditional advice won't just fail to make you money, it might actually put you in harm's way. The game has changed. The question isn't just how to grow your money anymore, it's how to keep from losing it when the market has a new set of rules. Let's be real about the global economy. After a surprisingly strong run, things are getting complicated. Major institutions like the OECD are calling for a cool down in global growth, projecting a slide from 3.2% in 2025 to 2.9% in 2026. This isn't just one thing. It's a mix of lingering trade tariffs, sluggish global trade, and general geopolitical weirdness that's making everyone hesitant to invest. Here in the US, the picture is just as fuzzy. Some forecasts see GDP growth rebounding to around 2.2% in 2026, thanks to easier money from the Fed and a boom in AI investment. But that masks some serious underlying weakness. Other economists see a slowdown, especially early in the year, leading to a K-shaped recovery where Wall Street and tech boom, while regular consumers and rate-sensitive industries get hammered. The risk of a recession hasn't gone away. In fact, a late 2025 survey from Natixis found that recession fears for 2026 have jumped significantly, with 38% of North American institutional investors now seeing it as a key risk, up from 20% the year before. The biggest wildcard, though, is policy uncertainty. Geopolitical risk now tops the list of economic threats for the big money players. On top of that, Federal Reserve Chair Jerome Powell's term is up in May 2026. While he could be reappointed, there's a lot of chatter about who might come next, which throws another layer of unpredictability into the mix. Will the Fed stay the course, or will a new chair with a new philosophy take over? The market hates uncertainty, and 2026 is dripping with it. Then there's volatility. It's not just a gut feeling, it's an expectation priced into the market. A Natixis survey of institutional investors shows 61% expect higher equity volatility in 2026. In that same poll, nearly 8 out of 10 North American institutions said they believe the markets are due for a correction, assigning a nearly 50% probability to a double-digit decline. Wall Street's own forecasts for the S&P 500 reflect this. While some firms like Oppenheimer and Deutsche Bank are bullish, calling for the S&P to hit 8,000 or more, others like Bank of America are far more cautious with targets around 7,100. The only consensus is that there is no consensus, and that in itself is a huge warning sign. For generations, the 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard. The idea was simple. When stocks zigged, high-quality bonds zagged, acting as a shock absorber. This negative correlation was its superpower. But that superpower is on the fritz. The main culprit is inflation. In an environment where inflation is high and sticky, the relationship between stocks and bonds gets weird. Instead of moving in opposite directions, they can start falling together. When a central bank hikes rates to fight inflation, it crushes bond prices. At the same time, those higher rates can choke off economic growth, which hammers stock prices. All of a sudden, both sides of your diversified portfolio are in the red. We saw this exact scenario play out during the inflationary spike of 2022-2023. While the negative correlation has shown signs of normalizing, its reliability is no longer something you can take for granted. So, what about the modern fix-it-all, passive investing? Just buy an S&P 500 index fund and call it a day, right? Look, passive investing is great for capturing market returns over the long haul. It's simple and cheap, but it has one giant mechanical flaw. It offers zero defense in a downturn. An index fund is, by definition, 100% invested all the time. If the market tanks 20%, your index fund tanks 20%. It can't sell, it can't hedge, it can't do anything but go along for the ride. To be fair, most active funds also lose money in a broad sell-off. The difference is the mission. A passive fund's job is just to copy the market. Certain active strategies, however, are built specifically to navigate and even profit from the very things that make passive investing so risky: volatility and dispersion. This brings us to the main idea here. In a world defined by volatility, uncertainty, and weird correlations, certain alternative strategies could give you a critical edge. Specifically, we're talking about hedge funds. Now, let's clear the air. The term hedge fund gets a bad rap, making people think of reckless Wall Street gunslingers. In reality, a hedge fund is just an investment structure. The name itself comes from the idea of hedging, or reducing risk. They are typically only available to high net worth individuals and institutions, and they have way more flexibility than your average mutual fund. They can invest in more types of assets and, crucially, use tools that are off limits to most retail products, like short selling. This flexibility allows them to chase absolute returns, meaning they aim to make money whether the market is up, down, or sideways. That's a world away from a passive fund that only works when the market goes up. Of course, this comes at a cost. Hedge funds are famous for their 2 and 20 fee structure, a 2% management fee plus 20% of the profits. They also usually ask you to lock up your money for a while. And let's be blunt, not all hedge funds are created equal. Performance varies wildly, and as a whole, the industry has gone through long stretches where it has underperformed simple, cheap index funds, especially after those high fees. So this isn't a blanket endorsement. This is about looking at specific hedge fund strategies that seem tailor-made for the challenges of 2026. 2 in particular stand out: equity long short and multi-strategy. Let's start with a classic, equity long short, or ELS. It's one of the oldest hedge fund strategies, and it's built for a choppy market. An ELS manager does 2 things at once. They buy, go long, stocks they think are cheap and will go up, and they sell short, stocks they believe are overpriced and will go down. Short selling is the secret sauce. It involves borrowing a stock, selling it, and buying it back later, hopefully at a lower price, to return to the lender. This gives the fund 2 ways to win. In a rising market, the long positions make money. In a falling market, the short positions are designed to make money, cushioning the losses on the long side. The potential here is to generate returns no matter what the market is doing. In a year like 2026, where Wall Street is all over the place and volatility is expected to be high, this 2-pronged attack is incredibly valuable. High volatility and a big gap between winners and losers are the perfect hunting ground for a skilled stock picker. But the key word is potential. An ELS strategy lives or dies by the skill of the manager. Finding good shorts is notoriously hard, and a bad bet can cost you. The performance of ELS funds is all over the map. Orum's Q3 2025 data showed equity long short as the top performing strategy, returning 6.5%. But that average hides a wide dispersion. Manager selection is everything. If an equity long short fund is a specialist, a multi-strategy fund is the ultimate jack of all trades. Think of it as getting several different hedge fund strategies in one package. It's kind of like a fund of funds, but all the teams are usually in-house, overseen by a central risk manager who decides where to put the capital. A multi-strategy fund might have one team doing equity long short, another trading currencies and interest rates, global macro, a third focused on mergers, event-driven, and another playing in credit markets. The boss can shift money to the strategies that look promising and pull it from those that don't. The main appeal is diversification. When the old stock-bond relationship is shaky, a multi-strategy fund offers diversification across strategies that are driven by completely different things. A macro strategy might actually thrive on the policy uncertainty that torpedoes a stock portfolio. A merger-focused strategy cares more about corporate deal-making than where the S&P 500 is headed. By blending these uncorrelated strategies, the goal is to produce steadier, more consistent returns. They aren't built to shoot the lights out in a bull market. They are built with the potential to grind out positive returns and protect your capital in the exact kind of choppy, sideways markets that many analysts fear for 2026. This approach has been gaining a lot of traction, with allocators in 2025 showing high interest in multi-strategy funds to build more resilient portfolios. We're covering a lot of complex stuff here, and I'm curious what you think. What's your biggest worry for your portfolio in 2026? Inflation? Volatility? Something else? Drop a comment below and let's talk about it. And if you're getting value out of this, do me a favor and hit that subscribe button. We go deep like this every single week. So why is this conversation so urgent right now? Because the specific problems on the horizon for 2026 are exactly what these strategies are designed to solve. Widespread expectations for higher volatility are a direct threat to passive investors. But that's the fuel for an equity long short manager. Market chaos creates the price disconnects they need to thrive. The wider the gap between winners and losers, the more opportunity there is to capture alpha, or skill-based return. The deep uncertainty around policy, from the Fed leadership to geopolitical hotspots, creates big picture trends that global macro traders, often found inside multi-strategy funds, can exploit. As traditional assets become more correlated, the diversification you get from combining multiple non-traditional strategies becomes exponentially more valuable. This is exactly what the quote-unquote smart money is doing. Recent surveys and data show institutional investors are getting more interested in hedge funds, especially multi-strategy and ELS. Total hedge fund assets hit a record of nearly $5 trillion in late 2025, with strong inflows throughout the year. There's a clear recognition that in the market we're heading into, just owning the index might not cut it. This has sparked a comeback for hedge funds, with Europe and Asia Pacific seeing particularly strong asset growth as allocators look for opportunities abroad. It would be irresponsible to sell these as a magic fix without talking about the risks. Hedge funds are complex, expensive, and definitely not for everyone. First, the fees are a killer. That 2 and 20 structure means a fund has to perform incredibly well just to beat a cheap index fund after costs. That's a high bar, and historically, the broad hedge fund industry has often failed to clear it. Second, your money can get tied up. Unlike an ETF you can sell any day, hedge funds often have lockup periods and restrictions on withdrawals. That means your capital could be stuck for months or even years. That's the trade-off for letting managers invest in less liquid assets and avoid being forced to sell at the worst possible time. Third, there's a high barrier to entry. In the US, you typically need to be an accredited investor, which means having a high income or net worth. This puts these funds out of reach for most people, though there are some liquid alternative mutual funds and ETFs that try to mimic these strategies with mixed results. And finally, the most important point, manager dispersion. The performance gap between the best hedge funds and the average ones is massive. Picking a fund isn't like picking an S&P 500 ETF, where they are all pretty much the same. Choosing the right manager requires a ton of research, and choosing the wrong one can lead to huge disappointment, no matter how good the strategy sounded on paper. Given all that, it's clear that getting ready for 2026 isn't an all or nothing bet on hedge funds. For most investors, they should be just one tool in a bigger, smarter playbook. So what else should you have on your radar? First, look beyond the usual suspects for diversification. If stocks and bonds aren't reliable partners anymore, broaden your horizons. This could mean more exposure to non-US stocks, especially since many institutional investors are looking to places like Europe and Asia for better returns. It could also mean adding some real assets and commodities, which can help hedge against inflation. Second, get tactical with your bonds. With rate volatility in the forecast, managing how sensitive your bonds are to interest rate changes will be crucial. Many strategists suggest focusing on shorter to intermediate term bonds to get a decent yield without taking on too much risk. Third, embrace active management more broadly. The consensus among institutional investors is that 2026 will be a year where active managers have a real chance to shine over passive funds. An environment with high volatility and a wide spread between winners and losers is exactly where a good stock picker can earn their fees. Fourth, don't forget about taxes. Smart moves like tax loss harvesting and maxing out your retirement accounts can add real value to your bottom line no matter what the market is doing. The investment world of 2026 looks like one of the most complex we've seen in a while. The old, simple rules are being tested, and the easy ride that lifted almost all investments for the past decade may be over. Volatility and uncertainty aren't just risks to be afraid of. They are the new reality we have to navigate. In this environment, just sitting passively in the same old assets may no longer be the safe bet you think it is. This is where the hedge fund hypothesis comes into play. Strategies like equity long-short and multi-strategy are literally designed to work in messy, unpredictable markets. They offer a potential way to not just protect your money, but to actually profit from the same chaos that threatens traditional portfolios. They aren't a cure-all. They're complicated, expensive, and come with their own big risks, especially the challenge of finding a great manager. But for sophisticated investors who do their homework, adding these kinds of strategies to a well-rounded and actively managed playbook could be one of the most critical moves you make. In a year where safety may be an illusion, taking a more active, unconventional approach might just be the smartest bet of all.